All right, let's keep rolling to the next type of option we're going to talk about today, which is incentive stock options, ISOs. So as we've discussed before, same type of deal. These are granted to you. Typically, you vest over a certain period of time, a number of years, monthly or quarterly or semi-annually, annually, whatever, according to the vesting schedule. But these work differently. These actually do have some tax advantages that RSUs do not. This is important. You have to qualify to receive the special tax treatment. Once you vest, once you've hit your vesting date, then you exercise the option to purchase those shares at a discounted price called the strike price. So you don't have to do that, obviously, but you can do that. You have the option to. It's your choice. Okay. If you choose to exercise the option, then you take the strike price times the number of shares that you vested, and that is the amount that you pay. And you'll actually pay that to the company, and then you'll receive the shares. Okay. Now, the difference between the fair market value of the stock at that time and your strike price becomes effectively your cost basis. So the difference between these two numbers normally would be a capital gain. It's considered a bargain element. So that's important. We'll talk about that importance really quick in a minute. But just remember, that's the bargain element. It's considered a benefit received from the company. Traditionally, that would be taxed as income from a company to an employee. But because of the special tax status that these shares have that you could qualify for, they just list it as the bargain element for now. So you pay the strike price, you get the full value of the shares. Now, if the special tax treatment is that the difference between the strike price or your cost basis and the fair market value of the stock can be taxed at long-term capital gains rates. So that could be 0 or 15 or 20%. Instead of regular income or short-term capital gains rates, which are based on your marginal tax rate. Okay, so to qualify, that's called qualified disposition. Okay, here are the requirements. You must hold the shares for at least 2 years from the date of grant. So if they're granted on, right, you get the ISO grant on a certain date, you must hold them at least 2 years from the date of grant and 1 year, at least 1 year from the date of exercise. If you do that and you meet those two requirements and then you sell the stock, you will only be charged long-term capital gains on that bargain element, right? The difference between your strike price or cost basis and the fair market value at the time of sale. That is a huge benefit, right? This could potentially be hundreds of thousands of dollars of bargain element that you're only paying 15% on, instead of 32%. Right? That's a massive tax savings, okay? But you have to meet those. If you don't meet those requirements, then when you sell, it's taxed as a short-term capital gain, okay, or regular income. So you basically don't get the special tax privileges that come along with that, okay? So that's how that works. Now, I've seen, for example, one of the things that gets people into trouble is not intentionally planning out when they're going to exercise their shares. So let me give you an example. Some people are like, oh yeah, I could exercise the shares, but I haven't. So I have like 3 years worth of ISOs that I just haven't exercised. It was granted several years ago. I just haven't exercised it yet. Okay, so one individual I talked to, they delayed exercising these shares for a while, a couple years. Then they caught wind that there might be some type of acquisition happening, right? Or like an IPO, something. And they're like, oh man, I better exercise my shares. So they exercised their shares. So they'd held it 2 years from the date of grant, but they had not held it for, they just barely exercised. So that starts the 1 year clock, 1 year from the date of exercise. Well, before that year was up, the company was acquired. And as part of that acquisition, they just bought out all of the stock, all of the shares owned by employees. So he sold all the shares. He was forced to. There was no other option. It was part of the acquisition agreement. And they were sold before he had held them for 1 year. So what happens? All of that value was taxed at regular income through no fault of his own necessarily, right? Through forces outside of his control, he ended up not meeting the requirement for qualified disposition and had to pay regular income tax on all of it, which was a lot. I mean, that was tens of thousands of dollars. So if he would have exercised when he vested, and as he went along, the vast majority of those shares he would have had held for at least a year. And then when the acquisition happened and the shares were purchased by the acquiring company, then he would have been taxed at long-term capital gains rates, okay? Much less than he paid. So that's something you got to really keep track of. Okay. And then the only other thing here is that bargain element, when you exercise the difference between your strike price and the fair market value at the time of exercise, that's the bargain element. You have to be careful and keep track of this. This bargain element is one of the components that is actually used in a separate parallel income tax calculation called alternative minimum tax, or AMT. So you've probably heard of AMT, and maybe you don't understand. I will do a video all about AMT, but bargain element is one of the things that influences it. And you could end up paying more tax through AMT than through regular income tax. So that happens in the case of like this, where you don't exercise, and then exercise a ton of shares in one taxable year, where you have a really large bargain element. That could trigger an AMT calculation and cause you to pay more taxes than you need to. So we'll talk about that in detail in another video, but I just want to put it out there so it's on your mind. All right, that wraps up this video on ISOs. We'll talk about ESPP, or Employee Stock Purchase Plan, next, and then wrap up the convo about stock options.
ISOs can save you taxes if you plan correctly.